Welcome everyone, and thank you so much for joining us today. I'm your host, Nugwa Haruna. If you've been shopping recently, chances are you've experienced the stink of high inflation. So many goods and services have become noticeably more expensive since the global pandemic. You have things like gasoline, groceries, electronics, and this is just to name a few. In fact, Canada's Consumer Price Index, which ranks inflation for a wide range of goods and services, rose by 6.9% year over year in April 2022. That's the sharpest move or increase in more than 30 years, according to data from Stats Canada. We know that high inflation can take a bite out of our spending money, but what does it mean for our portfolio? And what can we do about it? Well, we're going to get some perspective from a do-it-yourself investor who's been writing about the markets for over a decade. Mark Seed is the founder and editor of My Own Advisor, personal finance and investing blog for Canadians. Mark, great to see you, and thanks for taking the time to chat today.
Yes, well, thanks for reaching out, and it's a real pleasure to be here, and I can't wait to get into our conversation. It's an important topic for a lot of Canadians.
All right, so now before we dive into our conversation, I have a trivia question for our audience. And the question goes, the S&P TSX Composite tracks the performance of a wide range of Canadian stocks. How has it historically performed during periods when annualized inflation is 4% or higher? So we'll reveal the answer at the end of our conversation, so stay tuned for that. So Mark, we're going to jump into our conversation because we want to get to know you a little better. You've been blogging for over a decade at My Own Advisor. What gave you the inspiration to turn your self-directed investing experience into a passion project?
Yeah, it's absolutely a passion project, and I still enjoy it, looking at 12, 13 years later now. To be honest, My Own Advisor was born out of the desire to better manage my money. I wanted to understand where my money was going. I wanted to understand, coming out of the great financial crisis, 08, 09, which hurt a lot of investors quite hard. I wanted to understand what the value I was getting for some of the products or the fees I was paying. And truly, what I recognize, and again, I think all of us know this all along, is that nobody cares more about your money than you do. So I took it to heart, and I really tried to understand how fees could potentially impact my portfolio. Is there a better way to potentially invest my money and keep on top of my money? And so I started My Own Advisor kind of as most blogs really do, as a personal finance diary, an online diary, about chronicling my journey to financial independence. And that's sharing my pitfalls and my weaknesses, but it's also trying to broadcast some of my strengths and where I've actually learned to take better control of my money. So it is a bit of a labor of love, and I still enjoy it all these years later. But certainly I'm hoping to pay it forward through the site, and I'm hoping to help other Canadians as much as I can through my own story.
And congratulations, you're coming up on an important investing milestone. You'll soon reach your financial independence goal. So what do you have planned for semi-retirement?
Yeah, I mean, hopefully Nugwa travel. That would be nice with the pandemic being a little bit more endemic now. But I actually just want to spend more time doing some of the things that I haven't been doing, whether it's travel, whether it's maybe getting into better physical fitness. As you can see from my background, I really enjoy golf, and I'm passionate about that. So I'd love to play a little bit more golf. I'd also like to try some new things. There's a long laundry list, if you will, of things I really want to accomplish, and I feel that this financial independence, work on your own terms, kind of this FI-WOOP moniker that I have, it really appeals to me because I think I'll be able to meld a balance of, part-time work or semi-retirement work, keeping my mind and body active in the workforce, but at the same time having a little bit more time to do these passion projects or things that maybe I've put off for a little while. So super excited about the next few years ahead with my wife, but certainly we got a little bit more to go. But yeah, the journey's been super rewarding, and I can't wait to figure out what's next, to be honest.
Okay, so before we get into how you're dealing with high inflation, can you tell us, how would you describe your investing style and strategy?
Yeah, I've coined myself as a bit of a hybrid investor. I invest in some dividend-paying stocks for income and capital appreciation, but I also really enjoy and try to be as passive as I possibly can be in the broad markets, whether that's Canada, US, or international. So I'm really trying to take a bit of a lazy approach with part of my portfolio, where part of my portfolio is maybe potentially a little bit more active through those dividend paying stocks. I certainly don't trade very much. I kind of call it a buy and hold some more approach. So I tend to invest in, sectors or companies that I feel quite resilient, whether they're in Canada or the US. And the dividend portfolio that I have is quite passive in that I don't actually touch it very often. And like I said, if anything, I just buy more, air quote, when things go on sale. So that's been my philosophy.
Now, the inflation that we've seen in the first half of 2022 could impact your retirement plans as it can for all of us. But some investors aren't really clear on exactly how. So how would you describe the effects of persistently high inflation and the impact it can have on a portfolio?
Yeah, I mean, let's start with cash, right? So if your savings account is only getting, I wouldn't call it a high interest savings account, let's call it a modest interest savings account. So if your savings account is getting 1%, 2%, you can kind of see that inflation's slowly eating away at that 2% and reducing that purchasing power. So that's one thing to consider. I think we know the inverse relationship of interest rates and bonds, right? So interest rates go up and they have a negative correlation to bonds in some cases. Historically, we have seen these peaks and valleys where inflation does spike and level off and spike and level off. So when it comes to, and we'll talk about a little bit more, managing your portfolio, I think you need to be prepared that these spikes and peaks and valleys will exist. And you need to kind of hedge your portfolio that certain asset classes may perform better, and or you just need to be diversified and prepared that these spikes and valleys will happen, and that fits into your long-term game plan. So again, it's just to be mindful that these are cycles, and the markets are actually doing what the markets should do, which is they go up and down. And this is nothing to be overly scared about or fearful of. The reality is that the markets have been doing this for decades and generations, and they'll probably continue to do this for decades and generations. And it's really that behavior, that emotional fortitude that you need to have to be a little bit resilient and just understand that this is just history playing out again and again.
Now, when we're talking about asset classes that may have responded more negatively historically to high inflation, can you discuss some of those?
Yeah, I would say that the worst performing assets tend to be ones that deliver kind of, lower returns in generally speaking. So like, let's go back to the conversation about cash and bonds. Certainly higher inflation can be a major headwind for cash just because interest rates have to be quite high to combat that. And we're seeing interest rates go up. Bonds tend to get hit fairly hard just because think of bonds as like a big IOU. And that IOU is not paid out in terms of its interest rates very highly, and certainly when inflation hits, that becomes a headwind. Tech sectors or any sectors that rely heavily on growth oriented tend to be very challenging sectors to be in a headwinds that have high inflation or maybe even higher interest rates, and that's kind of what I think we're seeing playing out a little bit right now.
So, which asset classes have historically been most shielded from the impact of high inflation over the long term?
Yeah, I do like materials. I do like commodities. I also like energy to a degree. We've seen oil. Again, going back to the cycle conversation, you see these market cycles kind of go through peaks and valleys. You see maybe oil prices spike, and then what happens is potentially, not saying it's going to ever happen consistently, but maybe some sort of recession or bearish territory. I'm also a fan of utilities and financials to a degree. So I'm thinking about some of these sectors, a little bit of utilities for the stable income they provide because they can transfer their costs as an investor to me through their dividends or through their rising prices. So those are some of the sectors I looked at. There's also healthcare that folks may want to look at, but again, that's much more of a growth story potentially. So there could be some headwinds in that sector as well. And then there's consumer staples. Some of those consumer staples stocks, whether they're in the Canada, US, they can also pass some of their costs on to the consumer. So it's something to be mindful of. and in thinking about kind of as a DIY investor, potentially consider owning what you buy, right? So if you're a consumer of certain telco services, or you're a consumer of certain utility services or other, these are things that generally some people, most of us, can't live without, and so they tend to be a bit of an inflationary hedge. It's not to say that they're foolproof. Things can go up and can go down, sometimes quite drastically, but at the end of the day, there are certain types of services or goods that most of us just can't live without.
Okay, so speaking about hedging, your portfolio against inflation, there's a lot of debate about the merits of gold and even cryptocurrencies as potential hedges. So where do you stand on that?
Yeah, that's a great question, because I've seen so many articles of late about gold, or digital gold, as some people call it, with crypto and such, being kind of an inflationary hedge, and I just don't buy it. I think we're in an area where, years ago, decades ago, gold tended to be a safe haven, or gold bullion tended to be a safe haven, just because the retail investor did not have access to any sort of total market funds or ETFs that most investors have right now. So I think about all the available assets, all the available sectors that most retail investors can get through low-cost ETFs, or directly through a low-cost discount brokerage. I just don't see that everything that glitters should be related to gold. And when it comes to cryptocurrency, it's a very new asset class. It's still very much an alternative asset class. I think people need to consider that the whole part of the alternative asset class is potentially high risk, but also indiscriminate reward. So personally, I'm not a huge fan of gold as an inflation hedge, and I think the jury's still out, certainly long term, when it comes to any sort of cryptocurrencies.
We talked about some asset classes that have performed relatively well during periods of high inflation. And so some investors may be tempted to overweight their portfolio in those asset classes during periods of high inflation. And what's your take, or what's your stance on that?
Yeah, I don't mind. I don't mind being strategic, because I think that way too. You can certainly watch some of the news, and you can certainly read some of the reports, but I would say, if you're going to make some strategic calls on asset classes, do it conservatively. So, investors can look at the TSX, or they can look at the S&P 500 for hints about sector allocation, and watching the index and seeing how it weights certain asset classes, knowing that long-term returns from 100% equities is generally quite favorable. Those can be hints for some folks to start thinking about how much sector allocation should I have, and if you're going 10 or 15 or 20% beyond that, there's absolutely some reward potential, but there's also some risk too, and so you need to keep that in mind as an investor. High risk could yield high returns, but certainly high risk could yield much damage to your portfolio. So I think it's really good to have diversification that aligns with your risk tolerance and your goals in mind, and it's all part of a long-term plan. Anything that happens in the next 6 weeks or 6 months, and in some cases 6 years, shouldn't really have much to do with your time horizon that's 30 or 40 years out, especially for people in our asset accumulation years like myself.
Right, so that's that importance of having an investment plan, because within an investment plan, when you create your investor profile, you can look at what the asset allocation would be in there. You talked about the importance of diversification, so essentially not putting all your eggs in one basket. So members of the audience who want to learn more about building a diversified portfolio can check out our video course, Managing a Portfolio, in the Learning Center. Okay, so now, Mark, many investors are fretting about the impact of high inflation and wondering what to do about it, but you're largely sticking to your plan. Why is that?
I have confidence in it, to be honest. I mean, I think having a plan, plans can change, and I'll come back to that point in a second, but I think having a plan about how, and what I mean by a plan is not just about investing, it's about how I'm paying down my debt, how I'm managing my insurance in case a catastrophic, unforeseen thing would happen to myself or my wife. It's about actually enjoying the things that life provides today, whether it's the golf course or hopefully travel or those types of things. So to me, having a plan is not just about the investing arm, it's about a whole bunch of other things as well. And so I've devised my plan over many years, but to my earlier point, it's the process of replanning that's super important. Things change, and so life changes. And so while your plan needs to be resilient, it's an opportunity for you to look at your goals, look at your objectives, monitor yourself, and see if you need to tweak anything along the way. So whether that's every 6 months or whether that's a coffee talk around the family table once a year for a little bit. I think it's the process of replanning that people need to get into a habit to, that really the true power of sticking with kind of a long-term goal in mind, that really the true benefits come in.
Right. So, because as you mentioned, that plan almost takes away some of that emotional investing that we mentioned earlier, right?
Yeah, you get away from this knee-jerk reaction. So I've tried to train my investing brain. I'll go a little bit, if you will, over the years where I've tried not to react to what's going on in the market, whether the TSX index is down a bit or the S&P is down a bit. And the stock market's a funny place because it's one of the places where there's a lot of euphoria when things go up, but people get really antsy and fearful and obviously sell stuff when things go down. And so nobody in their right mind would go to the grocery store and see, apples and, their favorite dishes on sale and just go, oh my gosh, I can't be bothered with that. But the stock market's a funny place where there's just such an emotional tie to the money and where your money's going. So I think if you can learn to train your investing brain a little bit and consider these opportunities as means to put a little bit of extra money into the stock market, again, aligned to your long-term plan, whatever that's 5, 10, 20 years out, I think people are going to be significantly rewarded over time by having the opportunity to buy things, relatively speaking, when the prices are down.
So that said, in your opinion, what are some tangible steps investors can take within their investment plan to curb the impacts of high inflation?
Yeah, I think you need to be mindful. I'm a big fan personally of having a little bit of an emergency fund or a cash wedge where should something unforeseen happen in my life or our life, that if we need the money, we're not selling any assets to fund that. I would also really look when it comes to inflation. Look at your budget, and I don't mean budget in a bad way that you need to be very systematic about you have to spend only this money on these things, but it's more around just looking to see if you're getting value for the money that you're spending on, whether it's your subscriptions or whether it's the groceries or the day-to-day goods and services that you're buying. I think revisiting a little bit of your budget to see where you can cut back is also helpful. And then again, when it comes to the investing side, I think having a little bit of bias to stocks, a little bit more than bonds, which is a little bit more than cash, and having that long-term disciplined mindset is really going to help a lot of Canadians during a very tough time. So I think those are the kind of three key things that people can think about to help them curb inflation, and hopefully it's a short-term tenure thing. It's maybe over the next 1 or 2 years where we're seeing things run a little hot. But again, the future is always an uncertain place, and we need to be mindful that plans can change, and your plan needs to change with it.
Right. So speaking about plans, just a reminder, within WebBroker, there is the goals tool that investors are able to use to adjust those investment plans as circumstances change. Now, Mark, you say you see higher than average inflation continuing for 1 to 2 years. So what are some steps you might personally take to adjust your portfolio with that in mind?
I have been looking at the energy sector for the last few months, and so that's one of the sectors that I thought, jeepers, looks like the energy sector was starting to take off a little bit in the last few months, and so I have been looking at keeping some assets in that sector for sure. I've already mentioned I do have a fairly good weighting of utilities and also some materials and commodities in my portfolio. So I'm looking at that just to make sure that it still aligns to my risk tolerance. But honestly, I'm not doing too much different. I know that these are interesting times, and just like in 2021, it seemed like everything was going up. Housing was going up, crypto was going up, the stock market was going up. Inflation wasn't going anywhere, and neither were interest rates. And so, for the longest time, it was a bit of an upside down world, I call it, where everything seemed to be going up, and all the money was fairly cheap to get and access. And now things are starting to shift and revert to the mean maybe a little bit. So I'm actually not doing too much different, but I am looking at some sectors to see if I could take advantage of some upswings. But all those upswings are totally in line with my personal risk tolerance and making sure that any one asset class isn't tipping the apple cart per se.
Okay, so can you share what your asset allocation makeup looks like during periods of high inflation?
Yeah, right now I'm not far off, the TSX 60 in Canada, so I tend to use the TSX 60 index as kind of my proxy for my own DIY portfolio, and I have done so for years. So when we break that down and unpack that a little bit more, my financials are hovering around 25-30% of my weight. My energy is probably around 20% or so right now. Um, when I think about the telecommunications or communications industry, I probably have a little bit higher allocation just because the companies I invest in tend to reward shareholders through dividends or capital appreciation. Probably 5 to 10% there. Um, and then basically a lot of the other sectors are a blend between 5 and 10% asset allocation, whether you're talking about commodities, some materials, tech, and so on and so forth, utilities. So I try not to go too much astray from what the index is doing, but I do have a bit of a personal bias into having a little bit more telco and a little bit more utilities, just because I feel some of those companies offer very dependable income. Some of the companies tend to grow their dividends, and they also have a little bit of price appreciation over time as well.
All right. So, what do you think about dollar cost averaging investing versus lump sum investing during periods of high inflation?
Yeah, this is a really interesting question because lump sum investing tends to be better because you get your money working in the market faster, and that allows time to compound. The reality is we're all creatures of habit, and we all have emotions with the money. And so if you need to do the dollar cost averaging, whether it's high inflation or low inflation, high interest rates or low inflation rates, that's okay. Stick to a program where you can invest maybe a little bit every month or every quarter, and just kind of keep doing it and rinse and repeating. So I don't have a firm answer on that. Lump sum investing tends to be better, but honestly, we're human beings and we're flawed. And if it helps us sleep better at night to do the DCA, the dollar cost averaging, go for it.
Right. So, we had talked earlier about your timeline for semi-retirement, but with this high bolt of inflation, um, has that forced you to reconsider your timeline at all?
Uh, Not really, not yet. My wife and I are fortunate enough to be, I think, saving well and trying to live within our means or try to live below our means most of the time, if not all the time. And so I've tried to design my plan around the fact that semi-retirement may be a couple years away. I absolutely want to stay, working and be, you know, contributing where I can, but I just want a little bit more of my time back, if you will. So I think that's something I'm looking forward to. So yeah, to answer your question, I think the timeline for semi-retirement in the next 2 to 3 years hasn't changed at all. I'm absolutely looking forward to it. I can't wait. And I think I've designed my financial plan, or at least my investing plan, in particular around, poor markets, bad sequence of returns, and so on and so forth. I obviously hope things will rebound, but my plan is hopefully a bit of all weather and a little bit weatherproof to withstand some downside risk in the coming years as well, and keep our objectives kind of on track as well. So it's a good news story so far, so good. But I'm happy to come back and talk more about it if and when things change, of course.
So thank you so much for sharing your perspective. And we're not done yet because we're going to transition into the live question and answer in a moment. But first, I want to introduce everyone to the asset allocation tool in WebBroker, which can help you track your exposures to different asset classes. Once in WebBroker, click on Accounts. Under Account Details, click on Asset Allocation. Asset allocation involves investing in different asset classes, such as equities,
which include Canadian, US, and international equities, fixed income, which include Canadian or global fixed income, cash and cash equivalents, and may include other alternative asset classes such as commodities and real estate. Since different asset classes respond to different market conditions in different ways, an investor could manage the risk of investing in the markets through portfolio asset allocation. Now, for an investor interested in seeing the performance of each of these asset classes within their portfolio, they're able to do so by scrolling down, taking a look at the weight of each asset class within their portfolio, as well as the performance of each asset class within their portfolio. For an investor looking to see the historical returns on different investor profiles, they're able to do so by using the Goals tool. Once in Goals, an investor is able to choose a goal. On the second step, an investor is able to compare different investor profiles. For this example, we're going to stick with a moderate investor profile. Once here, an investor can see what the asset mix as well as the asset breakdown within a moderate investor's portfolio would be, as well as what the historical returns have been in the last 15 years for a portfolio holding this asset mix. What the best year has been, what the worst year has been, as well as what the annual average return for this type of portfolio has been in the last 15 years.
So that's how the asset allocation tool can help investors keep tabs on the composition of their portfolio, no matter the economic conditions. Now, just one last thing before we head into our question and answer segment, and that's the answer to a trivia question. As a refresher, the question was, the S&P/TSX Composite Index tracks the performance of a wide range of Canadian stocks. How has it historically performed during periods when annualized inflation is 4% or higher? And the answer is the S&P/TSX Composite Index produced an average annualized return of 2.3% during times when inflation was at least 4%, according to a report by analysts at National Bank Financial in 2021. That might not sound like much, but that was better than the S&P 500 index, which measures a wide range of US stocks. It was down an average of 5.9% annually during those periods of high inflation. The analysts say the larger weighting of commodity stocks in the TSX Composite Index is one reason for its outperformance. And Mark, you had talked about, commodities as potentially, a sector that may perform relatively well during, high inflation and market volatility, right?
Yeah, absolutely. And I think, history can be a good teacher. It doesn't mean it's always a straight line to what the future may hold, whether it's 1 year or a few years. But the TSX is historically fairly resilient because of the energy bias, because of maybe the tipping in financials, but also those commodities and raw materials. We're a resource-rich nation. We're very fortunate. I hope it always continues, but in some cases, it's okay to have a little bit of money at home, and I think we're seeing that play out when it comes to inflation and higher rates. So these are just considerations for all investors. And I hope that helps folks make some really good decisions as part of their long-term plan.
All right, so let's head over to a live Q&A, Mark, and give the audience an opportunity to get their questions answered.
Great stuff.